Tonight's breaking news. Hi, I'm Darryl Breland, reporting live almost from our Madison, Mississippi news desk. This week's sales story is going to help you in many ways. And today we're going to talk about the very best health insurance bundle ever. Bundling, or the bundle, is a reference to packaging two or more different health insurance policies together to supplement one another to give better coverage than any one single policy can do by itself. First of all, imagine you're a business owner of a small company. You have 10 to 20 employees, for example, and you just got your rate renewal notice in for your group health insurance. The premiums are going to jump up 30% or more, and you really can't afford a 30% rate increase. You can't raise your prices that high to accommodate that, so you're really seriously considering doing away with it altogether. In fact, since you have less than 50 full-time employees, based on the government's definition, you don't have to even offer group health insurance. You can dissolve your plan and say, to heck with this anymore. However, what if you could come up with a plan where you said, I'm going to just offer an allowance to my employees, set them out, so I know what my cost is going to be this year, next year, and the year after that. And I'm going to offer the ABC company's plan at my expense, and I'm going to allow the employees the option of purchasing XYZ supplemental plan at their expense on a pre-tax basis under a cafeteria plan. A lot of words, but you'll learn about this later. First of all, let's take a look at their problem they have now. Their group major medical plan is a PPO. When they go out of network, they receive what's called a balanced bill. What's a balanced bill? That's when you go to the doctor or hospital, you pay your copay or meet your deductible, your insurance company pays all that it's going to pay, and then you still receive a bill from the medical provider saying you still owe us more money. That extra money that you owe is called a balanced bill and does not apply to your out-of-pocket maximum or your deductible, and that usually occurs, really exclusively occurs, I should say, most likely, when you go out of your plan's PPO network. Because if you stay in network, the providers have contracted pricing, so you almost never receive a balanced bill in network. I'm not aware of that happening ever. But let's say you live in an area where your network isn't very good. So your employees are going out of network a lot and they pay a copay and then they're still getting a bill. They're not happy. They think this insurance is terrible. Well, ABC's company's plan works very similar to that. You pay a copay. In this case, it's a $50 copay. Go to any doctor you want to, and it's a $50 copay. And if you stay in network with their PPO, you will not receive a balanced bill. But if you go out of network, you will receive a balanced bill. But how do we fix that problem? Well, with this supplemental plan with XYZ's company, it is an indemnity product. Because it's an indemnity product, and it, by the way, the very best indemnity product on the planet ever designed, I can pretty much guarantee that, both policies pay as if the other doesn't exist. So for example, if you go to a doctor and you pay your $50 copay and you're in network, that's it. You don't pay anything else. But your provider should file claims with both companies, and your second company, if you're on their preferred plan, will pay $160 for the doctor's office visit. It pays more for x-rays and lab work and all that stuff too. But let's just stick with the doctor's office visit. If you're on the preferred plan, it pays $160 for the doctor's office visit, and the bill is already paid over $50. You've actually made money. Now, that's not what the idea about. The idea is when you go out of network, instead of receiving a balanced bill, you'll receive enough money from your indemnity plan to cover the balanced bill, and most likely then some. That's even more important when you have major bills like surgery related or hospitalization. So here's a little bit more as we dive down into that.
ABC Company's plan works similarly to group health insurance or a major medical plan. XYZ's plan is an indemnity plan and supplements ABC's plan. Both plans pay as if the other doesn't exist. ABC's plan has no deductible to meet or coinsurance because it pays 100% of covered charges up to the usual, customary, and reasonable charges after a copay has been met. The maximum out-of-pocket pertains to the aggregate amount of annual copays. The XYZ plan has a deductible, but it's not a traditional deductible, meaning you don't have to be out of pocket before the plan begins paying benefits. It pays first dollar benefits, which means there is no copay or coinsurance. Additionally, there is no out-of-pocket maximum limit. Here's how it works. Should you go to the doctor, other than a wellness visit, you pay $50, and the rest is covered by your ABC plan, so long as you stay in network. If you use an out-of-network doctor, the plan works the same, but there is no guarantee the doctor won't bill you an additional amount. But, no worries, your XYZ policy will pay you a fixed amount for the doctor's office visit, lab work, and so on, even if our ABC plan pays the bill in full. Why have two plans? Both plans were designed to provide an affordable alternative to major medical plans, but that means they both have limitations. ABC's plan has a maximum annual benefit of $500,000 and limits the number of hospital days. The XYZ plan adds another $500,000 or $1 million in annual benefits, plus doesn't limit the number of hospital stays. Together, you have a comprehensive health package which is arguably second to none.